If you're like me that has been dreaming of making millions from stock, you've come to the right place. In this video, I'm going to take my time and lay out essential steps that you can take that will help you achieve financial success. First of all, let us understand what stocks are. So stocks are basically a way of making money, and stocks represent a form of ownership and a way for you to make money when the company grows over time. So when you buy a stock, you are essentially buying a piece of the company and you are betting on the success of the company in the near future. So that is basically what stocks are, and then that is basically what we're going to talk about today and how to make money from doing that. Now let us talk about the step-by-step investment guide that you're going to follow and that I follow for us to attain financial freedom together. The first step you're going to follow here is to set clear financial goals. If you realize the whole video, I keep saying the word financial freedom. I keep saying financial freedom because for me, that is my goal. I want to be financially free and be able to spend a lot of time with my family, provide for my family, my friends, without the hurdle of thinking about where money is going to come in next day. So you need to be able to set your clear financial goals. What are your reasons for investing in stocks? You need to be able to set that goal very clearly, because when it comes to a time that you're feeling unmotivated, you're feeling tired, you're feeling overwhelmed, and then the market is in a dump, you need to remember your why. That is what is going to keep you going. So you need to set financial goals. So for some people, those goals will look in the form of retirement. They are investing in stocks because they are trying to make provisions for their retirement. Others is to be able to make money to buy a home. Others are just looking for a way to make money to grow their wealth. That is simple as that. No matter what your reason is, once it makes sense to you, put that down as your financial goal. The next step we want to take here is to educate ourselves. The stock market is volatile at times, and therefore you need to make great decisions when it comes to investing in the stock market. So you need to educate yourself on the different forms of stocks, the businesses, and everything inclusive. So we need to be able to read books, take some courses online, and follow financial news to be able to tell exactly what is going, to be able to build a strong foundation. Knowledge in investing is absolute power. The more knowledge you have, the more information you have, the better decision making you can do. So we need to be able to educate ourselves. The third step here is to assess your risk tolerance. Everyone has certain risk tolerance because of their personality and their nature. I might be able to risk more than the next person could. So you need to be able to assess your risk tolerance and then be able to tell that this is what you need to do, and then this is the amount of risk you can take. For example, there are some certain stocks that are what we call penny stocks. They are more volatile and more risky to invest as opposed to certain big companies. However, the stocks, like we said earlier, understanding stocks is buying a piece of a company. Every company has the tendency of going bankrupt. Every company has the tendency of not generating revenue, and therefore you need to be able to assess those risks and know what you are involving yourself in. Certain industries actually have more risk as opposed to other industries. That is comparing, for example, the tech industry to the fashion or textiles industry. Buying stocks in each company or each industry has its predetermined risks that come alongside with buying the stock. You need to be able to assess that risk and know your tolerance level so that we can move on. The fourth step here is choosing the right brokerage. You need to be able to open an account with a platform. Because of digitalization and over the recent years, platforms like Robinhood, Fidelity, E-Trade, Vanguard, Schwab, they enable you invest your money easily with low fees. So pick a platform. It is not very difficult. You go to the App Store, you download Robinhood, or you download Trading 212, And then you even get free stocks when you download those apps and register. So I'll put a link to Trading 212 in the description that you can download and start investing. It is not very difficult. Once you complete the KYC, which is knowing your customer, you can go straight into investing. So just choose a platform. Like I said, I've recommended some. Go on YouTube, just Google and know more about those platforms. I recommend Robinhood, I recommend Trading 212, and I recommend Bamboo app. It's as simple as that. Don't make it complicated, because these are actually the very easy steps that we can take in these steps that we have to make money. The fifth step is to create a diversified portfolio. You cannot put all your eggs in one basket. I normally recommend people invest in index funds, but since today we are talking about stocks, you have to do the work yourself. Unlike the index funds that has 500 companies, top performing companies in them in a basket, where if you invest in the index fund, you are actually investing a piece of your money in across all those 500 companies. However, in this situation, building our diversified portfolio, we are actually doing it manually. Therefore, you have to diversify your portfolio. You can diversify about 30% of your portfolio into tech stocks, 20% into healthcare stocks, 20% into consumer goods, another 20% into ETFs. So we could have the index fund ETF, gold ETFs, Bitcoin ETFs. So generally 20% could go into ETFs, and then the last 10% could go into bonds. You could also revise it and then include maybe 10% into treasury bills. That is what we need to do. We need to be able to diversify our portfolio when it comes to investing in stocks, so that when something happens, our portfolio doesn't go crashing down. So the sixth step we need to take here is to research and select our stocks. So this is the crucial part when it comes to investing, and then the steps we are taking here. This is the crucial part. You need to be able to analyze the fundamentals of those companies, look at certain metrics that would give you an indication of if the stock is going to perform well or not. For example, you need to be able to look at their previous growth on the stock market. You need to be able to look at their revenue reports yearly. You need to be able to look at policies that have been put in place. You need to understand all this to be able to make a great decision when it comes to investing. When it comes to investing, like I was saying, knowledge is power. So you need to be able to understand and do your research in these companies. Now, the seventh thing we want to consider here is to make our first purchase. This is very simple to actually do. If you were taking 10% of your monthly income to put into investing, what we are going to do here is to go straight onto, let's say, Trading 212, invest $100, let's say, which is 10% of your income, and now split that $100 across your portfolio like you mentioned. So 30% should go into your tech stocks, another 20% goes into your consumer goods, another 20% goes into probably, let's say, real estate, venture cap. So you just need to be able to put that money in there and make your first purchase. It's just as simple as that. You put your $100, you buy $20 worth of Tesla, of Google. Just that simple. The eighth thing we need to do here is to be able to monitor and adjust our portfolio accordingly. You've done all the work. You just shouldn't let it sit there and go waste. Unlike the index fund, which I mentioned earlier, which constantly analyzes the stocks that are not performing well, drops them, and picks new companies that are doing well, yours isn't going to be like that because it's manual. So what you have to do is to do the work for yourself. You need to be able to analyze your portfolio and see which stocks are doing well, those that need to be dropped, and those that need to be added. It's just as simple as that. The next step, which is the ninth step that we have to follow here, is to reinvest our dividends. So there are some stocks that pay dividends, and therefore we need to be able to reinvest those dividends to make more money. On my TikTok channel, where I give advice on investing, I tell people to invest in stocks that strictly pay dividends, and that is just one investing strategy. I will talk about strategies in a bit. So what you want to do is to make sure you reinvest the dividends, because the idea here is to fall on the law of compounding interest. So we need to be able to leave that dividend in our account and reinvest it. Just as we would not touch the profits that are made per every stock that we buy, we are going to do the same for the dividends. You are leaving everything in your account, reinvesting every profit you make, and let it just sit there. Now, the last thing we have to do here is just to be patient. Be patient and be consistent. Keep following through with your investing strategy you've chosen. Keep investing a consistent amount, and you can increase it over time. Keep being consistent and be patient with your account. Don't see any little dip in your account and then decide to run and go and sell it or buy a new one. Leave everything as it is. Now, speaking of strategies, let me share with you 3 strategies that you can employ when you are investing and stick with it. The first investing strategy here is value investing. So with value investing, it became very popular because of Warren Buffett. And Warren Buffett just shows you that you have to look at the fundamentals of a company, buy a company that is undervalued and invest in it because of the future. It's just as simple as that. So what you're going to do is to look for undervalued company and invest in it. There's a caveat here. There are differences between investing in undervalued companies as opposed to investing in penny stocks. I will talk more about the mistakes very soon in the video. But what you need to do is to look for companies that are doing well based on the fundamentals, based on your research you've done, and invest in companies that are proving to do well. The next style of investing, or the next strategy you can employ, is growth investing. So with this style of investing, what you're looking forward to is to invest in companies that have an unlimited potential for growth. So a company like OpenAI, a company like Nvidia, they have unlimited bounds for growth, and those are very good companies that you can invest your money in. It's just as simple as that. So you do your research, you pick companies that are actually proven to do well or grow or show growth potential, and invest in those companies. Now, the third and the last strategy for investing is dividend investing. So all you're going to do here is just buying stocks that actually pay dividends, which is one of my favorite forms of investing. You pick stocks that pay dividends, and number one, you're making money from its growth potential, and also you're making money from dividends, and you are reinvesting the dividends in buying more stocks that pay dividends, and it keeps going on and keeps compounding. So those are the 3 strategies that are available for investing, and you can employ any of them that suits your personality, your beliefs, your potential, and your risk tolerance. Now we are going to talk about certain mistakes you can avoid when you start investing. So this is just going to be very fast. The first mistake you should avoid is the mistake of chasing hot stocks. Like I was speaking about penny stocks and all those things. You don't just get up tomorrow and hear Google is up, so you go and buy. Tesla is up, so you go and buy. Please stick to your trading strategy. Don't chase hot stocks. Pick stocks based on the metrics we've underlined, which are the revenue, the growth, the previous performance of the company, and your personal beliefs. It's as simple as that. The second mistake you should avoid when investing is ignoring fees. Certain platforms have higher fees than others. The fees on Robinhood is different from the fees on Trading 212. Please do your research and pick the one that suits you. The last mistake is not diversifying your portfolio. We've already spoken about diversifying your portfolio. Please take the advice and do it. If you love this content, kindly subscribe, leave a comment, like this video, share with your friends, and hit the bell icon so that when I release a new video, you'll be the first to receive it. See you on the next one.